All right, let's talk XP Inc. We're diving into their Q3 2025 earnings call, and wow, it's a fascinating one. The headline numbers, they look fantastic, but the market, not so impressed. So let's dig in and figure out what's really going on here.
So here's the big question, right? You've got record profits, a big beat against what the analysts were expecting. So why did the stock just sit there? It barely moved. That's the puzzle we're going to piece together. Why this massive disconnect between what looked like a home run quarter and how the stock actually traded.
Okay, so let's look at the tape. When the numbers first hit, the stock popped. It was up about 4% in after hours. You'd think, here we go. But then, reality set in. By the time the next trading day closed, all that excitement had fizzled out. It ended up with just a tiny 1.8% gain. I mean, it's something, but it's not what you'd expect. And the trading volume was huge, which tells you the market was really churning on this news. That initial excitement just didn't stick.
And this right here is where things start to get a little tricky. It's really a tale of two currencies. If you're looking at this in Brazilian reais, their local currency, it's a slam dunk. A clear beat on both the top and bottom lines. But, a ton of money that trades this stock is in US dollars. And when you do that conversion, the story changes. All of a sudden, earnings per share are just in line, and revenue actually comes in as a slight miss. So right off the bat, that currency headwind took a lot of the wind out of their sails for international investors.
Okay, so the headline numbers in dollars weren't exactly mind-blowing. So where did all that record profit in reais come from? Well, you have to look under the hood, because one part of the business is absolutely on fire right now. It's basically become their new growth engine.
And here it is. This chart tells you pretty much everything you need to know about this quarter. Look at that. The regular retail business, their bread and butter, it grew a solid 6%. That's not bad at all. But then you look at corporate and issuer services, C&IS. It grew an insane 32% compared to last year. That's not just growth, that's an explosion. This is the part of their business that deals with big companies, capital markets, that kind of stuff. And in a high interest rate world like Brazil's right now, these services are in super high demand. This isn't just a side gig for them anymore. It's the main event. It's what's driving the whole train.
And let's not forget the sheer scale we're talking about here. That growth is happening on top of a platform that now holds 1.4 trillion reais in client assets. That's a huge number, and it's up 12% from a year ago. What that really tells you is that even with Brazil's crazy high interest rates, people are still bringing their money to XP. That's a powerful signal.
Okay, so that's the what. Now let's talk about the how. What's the game plan from the top brass? It's actually become super clear. Focus on profits and give cash back to the people who own the stock. And you don't have to take my word for it. The CEO, Thiago Mafra, put it perfectly. He said, "This represents our commitment to deliver profitability even in more challenging market scenarios." And boy, did they deliver. A 23% return on equity is no joke. Think about it. Brazil's key interest rate is sitting at 15%. To generate returns that high above the risk-free rate, that just screams that their business model is incredibly resilient.
And this wasn't just talk. They backed it up with some serious cash. Management came out and announced two huge things. First, a new 1 billion real share buyback program. Second, a 500 million real dividend. They're basically doubling down on their promise to give 50 to 70% of their profits back to shareholders one way or another. The message is loud and clear. They are all in on capital discipline. But, it's never that simple. A great quarter doesn't exist in a vacuum. To really get why the stock shrugged, we have to zoom out and look at the bigger picture and some of the storm clouds that might be on the horizon.
And this right here is a really big piece of the puzzle. You got to remember where the stock has been. Year to date, XP is up 57%. I mean, it has absolutely smoked the S&P 500. When a stock goes on a tear like that, expectations get sky high. You don't just need a good quarter to keep that momentum going. You need a flawless, spectacular, lights-out quarter. And what they delivered was very good. But with that mixed picture in US dollars, very good just wasn't enough to get the bulls really excited again.
The Q&A part of the earnings call was also super revealing. You could really hear what the market is worried about. The analysts were hammering them with questions like, can you guys keep pulling in money from retail investors? What happens to your loan book when interest rates are at 15%? And the big one, was that 32% growth in the corporate segment a flash in the pan, or is this the new reality? On top of all that, management did what they usually do. They didn't give any hard numbers for guidance going forward. That lack of a clear roadmap always makes investors a little nervous.
All right, so let's put it all together. We've seen the good, the bad, and the complicated. So what's our call on XP from here? What's the verdict?
Our rating on the stock is outperform. Plain and simple. Yeah, the market paused, but when you look at the fundamentals and where the company is headed, we think the story here is incredibly strong.
And here's why. The thesis is actually pretty simple. First, management is just killing it. They're executing beautifully in a really tough environment. Second, that corporate and issuer services business, that's not a fluke. It's a real powerful second growth engine for them. Third, that aggressive buyback and dividend plan, it puts a nice, solid floor under the stock for investors. And finally, the business model itself is just fantastic. It's scalable, it's driven by fees, and it's showing operating leverage, which is just a fancy way of saying their profits are growing way faster than their expenses. And you get all of that for what we see as a pretty attractive price, trading at just 9 to 11 times what they're expected to earn next year.
So what's the play here? How do you actually trade this view? Well, look, Brazil has an election coming up in 2026, and that almost always means one thing: volatility. The market's going to get choppy. What's interesting is that management basically said on the call that they're ready for it. They talked about a plan to basically stock up on good assets when things get rocky so they can offer them to their clients later. That tells you they're thinking strategically. So here's the idea. Don't be scared of the volatility. Use it. Anytime the market freaks out over some macro headline and sells off the stock, that could be your chance to build a position for the long haul. We see this as a high-quality company, and those are the kinds of names you want to buy on weakness.
And of course, we have to say this is not financial advice.